Welcome back to the Deep Dive. We're here to cut through the noise, give you the insights that really matter.
That's the goal.
Today, we're jumping into a press release from SPAR Group, Inc. It covers their financial and operating results for the first quarter of 2025, ending March 31st. This just came out July 17th.
Right.
So our mission, as always, is to pull out the important stuff. Go beyond the headlines. What are these numbers really telling us about the company? Where it is now, and maybe where it's going.
Exactly. We want to help you understand not just, what they reported, but the why. Why does it matter? We'll connect the dots, look at the strategy, the financial health, give you the bigger picture.
Okay, let's get into it then. The first big thing that jumps out from the CEO, Mike Matacunas, he says this is the first quarter SBAR reporting without any international joint ventures.
Yeah, that's a major shift.
Huge. So what does that really mean strategically? Getting rid of those global operations.
Well, it looks like they're really simplifying things, focusing.
Yeah.
The international JVs, they added complexity, sometimes inconsistent results.
Right.
So shedding them means they can put all their energy into the U.S. and Canada business. It's about, streamlining, putting resources where they have more control, more strength, sharpening that focus. And
it seems like that focus is already showing some results.
What's that way?
The press release points to some good stuff from this North American pivot, like 6% top-line growth in the U.S. and Canada.
Solid growth there.
Yeah, and improved operating margins, and they even cut down their SG&A expenses, selling, general, and admin costs. And all that led to, $0.5 million in net income from continuing operations? That's 0.02 cents per share.
Yeah, and what's really interesting is how the CEO links this performance to what's next.
Okay.
Matacunas says they now have the, quote, largest pipeline of opportunity in SPAR's history. He's talking over $200 million of future business to chase.
Wow, $200 million.
Right, so it's not just, hey, we had a decent quarter. It's more like we've cleared the decks, focused the business, and now we're positioned to really go after significant growth. It signals a pretty aggressive strategy now that they're, leaner.
Okay, that makes sense.
Yeah.
But it hasn't all been smooth sailing, right? Companies often sound optimistic after sorting out some issues.
Okay.
And the press release does tackle two other, pretty significant items head on. First, that merger agreement with Highwire Capital, it got terminated. What happened there?
Yeah, that was pretty straightforward, according to the release. Highwire Capital just couldn't come up with the money to close the deal. So the board, the CEO, they expressed disappointment, naturally, but also said they're committed to going after the termination fee from Highwire.
Right.
Or, as they put it, something of greater value for our shareholders. So they're not just writing it off. They're trying to recover value from that failed deal.
Okay, so that's one hurdle. What was the other? You mentioned two.
Right. The second one involves filings. Always gets investors' attention.
Delayed filings. Uh-oh.
Yeah, the 10K, their annual report, was late. And because of that, the 10Q, the quarterly report we're discussing, was also late.
What was the reason they gave for that?
Well, the explanation was tied to the merger. They said the 10K was late because, frankly, they expected the Highwire deal to close and the company to go private.
Ah, okay. So they weren't planning on needing to file it as a public company.
Seems to be the implication.
Right.
And the 10Q delay followed from the 10K delay. They do say they expect to be current once this 10Q is actually filed.
So how does the CEO kind of square these issues, the failed merger, the late filings, with the operational performance he's talking about?
That's a good question. He basically draws a line. He explicitly says shareholders should be enthusiastic about their operational strength despite these delays. Yeah, it's basically saying, look, we had some administrative turbulence related to a deal that didn't happen, but don't let that distract you from the fact that the core business is performing well and focused. It's a bit of a balancing act.
Okay, let's dig into those core numbers a bit more then. The Q1 2025 highlights. Net revenues were $34.0 million.
Right.
And the consolidated gross margin, that improved, came at 21.4% of sales. That's up from 19.7% last year.
Yeah, and that improved gross margin is definitely a key positive. It really backs up that story about better operational efficiency in the U.S. and Canada.
Right, the focus paying off.
Exactly.
Yeah.
Getting more profit from each dollar of sales. That's fundamental, especially after a big strategic shift like shedding the JVs shows the remaining core is, healthier.
Okay, so better margins.
Yeah.
But then we look at the bottom line. Net income attributable to SPAR Group from continuing operations. $0.5 million, or 0.02 SROs PERS. But last year, Q1 2024, it was way higher, $6.6 million, 0.26 per share. That seems like a huge drop. What's going on there?
Ah, yes. This is like the perfect example of why you have to read the footnotes, you know?
Okay.
The crucial detail is that the Q1 2024 number, that $6.6 million, included a massive $7.2 million non-cash gain on sale, plus some other smaller non-recurring bits.
Oh, right. So a one-off gain.
Exactly. A huge one-time item that boosted last year's number but had nothing to do with, like, the day-to-day operations, if you strip that out.
Then this year's $0.5 million looks much more stable, maybe even better operationally compared to the underlying business last year.
Precisely. It's not an apples-to-apples comparison on the surface. This quarter's $0.5 million is a much cleaner reflection of their current focused operational performance.
That makes a huge difference in how you read those results.
Okay. What about adjusted EBITDA? That's another metric people watch.
Right. Adjusted EBITDA. It came in at $1.5 million for the quarter, which is about 4.4% of sales.
And how does that compare?
It's down a bit from the prior quarter, Q4 2024, which was $2.5 million or 5.0% of sales. But again, context matters.
Adjusted EBITDA tries to show core profitability. For a company that just went through a major restructuring, seeing a slightly lower but still positive adjusted EBITDA suggests the core business is holding up pretty well during the transition. It's not falling off a cliff. Shows some resilience.
Got it. And quickly, what about their financial position? Cash, liquidity.
Sure. As of March 31st, they reported total worldwide liquidity of $23.4 million.
Okay.
That's mostly cash. $17.9 million in cash and equivalents, plus $5.5 million they could draw down if needed.
Big cash flow.
For the quarter, net cash used by operating activities was $4.0 million, and they ended the quarter with net working capital of $15.7 million.
So connecting that back, does that liquidity seem sufficient given the cash use and their plans?
I'd say it looks pretty solid for where they are now. That $23.4 million in liquidity gives them a good cushion. It covers the cash burn they saw this quarter and provides flexibility.
Flexibility to fund operations and chase that $200 million pipeline.
Exactly. It suggests they have the resources internally to pursue that growth without needing to immediately run out and raise more capital. It signals stability after the big changes.
Okay. So looking ahead, the CEO wraps up on a positive note.
Very much so.
He says they're positioned to make some really exciting announcements over the next 6 months, and also that their second quarter performance looks good. Plus, a thank you to the employees and the board.
Yeah, that language, exciting announcements, Q2 looks good, really doubles down on the optimism. It suggests they feel they've turned a corner, reset things, and are now ready to sort of drive forward, build momentum.
Makes sense. Now, finally, every press release like this has that cautionary note regarding forward-looking statements. It's easy to just skip over it as legal stuff.
Right, the boilerplate.
But why is it actually important for us, trying to understand the real picture?
It's super important. It's not just lawyers covering themselves. It's a legally required and very real reminder that things can go wrong. When a CEO says, we expect, or we believe, or talks about exciting announcements, those are forward-looking statements. This note reminds everyone that those statements involve risks, uncertainties, things beyond the company's control.
Like what? Market changes, competition.
Exactly.
Yeah.
Economic downturns, client losses, failing to win that pipeline business, unexpected costs, loads of things. The note basically warns you not to put undue reliance on those optimistic statements because actual results could be very different.
So it's a reality check.
It's a critical reality check. It forces you to think, okay, the outlook sounds good, but what could actually prevent that from happening? It encourages a more balanced, skeptical view, which is essential for being well-informed.
Right. Okay, so let's recap the key takeaways from digging into this Kamar Group release.
Sounds good.
They've clearly refocused the business on North America, shedding the international complexity.
Check.
And that focused U.S. and Canada segment is showing growth and better margins.
Yep, positive signs there.
They've also addressed those past issues, the failed merger, the late filings, pretty openly.
Acknowledge them, explain them.
And the leadership seems optimistic, pointing to a big pipeline and hinting at good news to come while having a decent liquidity position.
That's the picture they're painting. Focused, stable, and aiming for growth.
And I think the big lesson here, like you said, is really digging into the details. That $7.2 million gain last year completely changes the narrative on net income if you don't spot it.
Absolutely. Understanding those nuances, non-recurring items, the why behind the numbers, that's how you truly get a handle on a company's performance, about building that deeper understanding beyond just the headlines.
Couldn't agree more. So here's something for you, the listener, to think about as you do your own research. Seeing how SPAR Group refocused, can you spot other companies, maybe in industries you follow, that are doing something similar, shedding non-core parts to unlock value in their main business?
Or maybe think about what other fine print you might find in reports. What details, beyond the big numbers, could change your whole perspective on how a company is actually doing?
Definitely something to consider for your next deep dive.